Hello everyone, welcome to the 209th episode of me learning how to trade in Forex. So in the last episode we went through what are currency futures, how they work in trade investing. So currency futures are exchange traded futures contracts that specify the price of one currency at which another currency can be bought or sold at a future date. So currency futures contracts are legally binding. The prices of currency futures are determined when the trade is initiated. Currency forwards rates are based on the currency spot rate, so currency futures tends to change as the spot rate changes. And then we went through foreign currency swap, so definition, how it works, and types. So foreign currency swap is an agreement between two foreign parties to swap interest payments on a loan made in one currency for interest payments on a loan made in another currency. So one purpose of engaging in a currency swap is to procure loans in foreign currency at more favorable interest rates that might be available borrowing directly in a foreign market. So currency swaps differ from interest rate swaps in that they can also involve principal exchanges. So the secured overnight financing rate is the average interest rate that the international banks use when borrowing from one to another. Two main types of currency swaps. So we've got fixed for fixed rate, exchanging fixed interest payments in one currency for fixed interest payments in another. Fixed for floating rate, so fixed interest payments in one currency are exchanged for floating interest payments in another. The principal amount of the underlying loan is not exchanged. So reasons for using currency swaps: decreasing borrowing costs and reducing exchange rate risks. So now we're on to 7 currencies worth more than the USD. So Investopedia, 7 currencies worth more than the USD. Date is the 27th. Right, so learn about the currencies that are priced higher than the USD and the factors that contribute to their strength. So when it comes to currencies, the terms price and value have distinct meanings. The price of a currency is the rate at which it can be exchanged for another currency. On the other hand, the value of a currency refers to its purchasing power. That is, the amount of goods or services that can be bought with a unit of the respective currency. So, price, so is the price of a currency the price of currency. So the rate at which it can be exchanged for another currency. The rate at which it can be exchanged for another currency. The rate at which it can be exchanged for another currency. On the other hand, the value of a currency, so value of currency, refers to its purchasing power, so its purchasing power. That is the amount of goods or services that can be bought with a unit of the respective currency. So the amount of goods and services that can be bought with a unit of the respective currency. With a unit of the respective currency. The price of a currency, better known as its foreign exchange rate, does not always reflect its value or worth purchasing power. For example, a country may have high exchange rate due to high demand for its currency in the FX market, but if prices are high in that country, i.e. has low purchasing power, then the value of the currency may be lower than what the FX rate suggests. The FX rate. With the USD, which is the world's reserve currency, it is interesting to note that other currencies that are priced higher. It's interesting to note the other currencies that are priced higher than USD. Key takeaways: the USD is the world's reserve currency. Some currencies of other countries are more valuable, meaning that $1 is worth less than 1 unit of the foreign currency. A more valuable foreign currency does not necessarily mean that the foreign economy is larger or stronger. Exchange rates can either be fixed or floating. Exchange rates are set by the variety of factors, including the amount of money in circulation. So types of exchange rates. An exchange rate is the rate at which one currency can be exchanged for another. There are two basic types of exchange rates: a fixed exchange rate and a floating exchange rate. So two basic types of exchange rates, so fixed and floating. Fixed exchange rate is a rate set and maintained by a country's government or central bank. So two basic fixed exchange rates. So a rate set and maintained by a country's government or central bank. So a rate set and maintained by a country's government or central bank. So a rate set and maintained by a country's government or a central bank. The rate is pegged to some value, such as gold or another currency like the USD. This system aims to keep the value of a country's currency stable. The rate is pegged to some value, such as gold or another currency like the USD. The rate is pegged to some value, such as gold or another currency like the USD. So if gold or USD moves up, then that exchange rate is also going to go up, and if gold USD goes down, the exchange rate also goes down. I'm assuming that's what it means. The system aims to keep the value of a country's currency stable. So this system aims to keep the value of a country's currency stable. The other type of exchange rate is a floating exchange rate. This is a rate that is determined by the foreign exchange market through supply and demand. So the rate determined by the foreign exchange market through supply and demand, through supply and demand. Under a floating rate exchange system, a country's currency rate can fluctuate from moment to moment. So a currency's exchange rate can fluctuate from moment to moment. A currency's exchange rate can fluctuate from moment to moment. Calculation of an exchange rate. An exchange rate is a value at which an exchange rate is a value of one country's currency in relation to another currency. For example, if the USD CHF exchange rate is 1.15, it means that 1 Swiss franc is worth 1.15 USD. No way, it's the other way around, is it? It will take 1.15 CHF to get 1 USD. Yeah, because that's a base currency, that's a quote. The base currency is always 1, so that means it should be 1 USD. So if the USD CHF exchange rate is 1.15, that means it would take 1.15 CHF for 1 USD. So I think they wrote that wrong. Exchange rates fluctuates based on economic factors such as inflation, interest rates, and geopolitical events. These factors will increase or decrease the supply and demand for a particular country's currency and thus influence the exchange rate. Based on economic factors such as inflation, interest rates, and geopolitical events. And These factors will increase or decrease the supply and demand for a particular country's currency and thus influence the exchange rate. So these factors will increase or decrease the supply and demand for that country's currency, which will affect its exchange rate. Factors that affect currencies. The value of a currency in the FX market can be influenced by various factors, leading to its increase or decrease in value. Some key factors include, factors that affect currencies. So, interest rates. If a country's central bank raises interest rates, that country's currency becomes more attractive because investors can earn more on their investments within that country. As demand for the currency increases, so does its value. So interest rates and the country's exchange rate, I guess, has a positive correlation. So as interest rate increases, its its fixed exchange rate. Oh no, not fixed exchange rate. Its floating exchange rate also increases. Which as interest rate increases, I guess that would depend on whether that currency is a quote or a base currency. If a country's central bank raises interest rates, that country's currency becomes more attractive. That country's currency becomes more attractive as investors can earn more on their investments within that country. As investors can earn more on their investments in that country. As demand for the currency increases, so does its value. As demand for that currency increases, so does its value. Quote and base currency. So if the interest rate for that country increases, and if that country's currency in a Forex pair is the base currency, so on the left, as demand, so if its value increases, that means if it's a base pair, if it's a base currency, then the exchange rate, then the value of the pair is going to go up, because it's going to take more of the quote currency to exchange for one of the base currency if the base currency does increase in value. So if interest rate goes up, and if that country's currency is the base currency, then the exchange rate is going to go up. So that's a positive relationship, positive correlation. If that country's currency is the quote currency and its value increases, that means the exchange rate is going to go down, because it's going to take less of the quote currency to get one base currency as the base currency increases. As a quote currency increases in value. So if that country's currency is the base, the quote, then it's going to go down. So there's a negative correlation. Next one, inflation rates. A country with low inflation rates compared to others will see its currency appreciate. Lower inflation rate implies an increase in the purchasing power of the currency, which investors would find attractive. Country with lower inflation rates compared to others will see its currency appreciate. Compared to others will see its currency appreciate. Low inflation rates implies an increase in the purchasing power of the currency. So lower inflation rates implies an increase in the purchasing power of its currency, which investors would find attractive. Because you can buy more stuff with the same amount of cash. Imply an increase, so yeah. So if investors find it attractive, then the demand for it's going to increase, which would increase its value. Economic performance. If a country's economy is doing well with strong growth and high productivity, its currency is likely to appreciate. On the contrary, if the economy is in a recession, the currency is likely to depreciate. So if a country's economy is performing well with strong growth and high productivity, its currency is likely to appreciate. Then its currency is likely to appreciate. If the economy is in a recession, the currency is likely to depreciate. Performing strong growth and high productivity, then its currency likely to appreciate because investors find it more attractive to invest in there, so which increases its demand. Political stability and performance. Political stability and performance. Countries that are stable, have transparent legal systems, and are secure and politically peaceful are considered safer investments, leading to currency appreciation. So countries that are stable, have transparent legal systems, and are secure and politically peaceful. Secure and politically peaceful are considered safer investments, which leads to currency appreciation. Balance of trade. This refers to the difference between a country's exports and imports. So the difference between a country's exports and imports. If a country exports more than its imports, trade surplus, its currency is expected to appreciate due to a high demand from foreign entities purchasing its goods and services. If a country's exports is larger than imports, so trade surplus its currency is expected to appreciate as higher demand from due to higher demand from foreign entities, as higher demand from foreign entities purchasing its goods and services. Public debt. Public debt. Countries with high level of public debt appears to be less attractive to foreign investors due to the higher risk of default as well as the possibility of inflation. This can cause the currency to depreciate. Public debt appear to be less attractive to foreign investors due to the higher risk of default. Higher risk of default. What does higher risk of default mean? Higher risk of default as well as the possibility of inflation. This can cause the currency to depreciate. Countries with high level of debt. High level of public debt appear less attractive to foreign investors. Appear less attractive to foreign investors due to the high risk of default. Due to the high risk of default, as well as the possibility of inflation. As well as the possibility of inflation. This can cause the currency to depreciate, which can cause the currency to depreciate. So there's more supply than there is demand for it, then its value is going to depreciate. Higher risk of default as well as the possibility of inflation. So there's a high debt, then there's a high possibility of inflation. Why is that? So inflation rises the prices of goods and services. If the price of goods and services increase, does that mean the tax collected from the goods and services also increases? So more money to the government, which they can use to pay off the debt. And also, if inflation rises, then there's going to be less purchasing power with the foreign investors. Oh no, the foreign investors are going to have less purchasing power, so it's just less attractive for them to invest in general. Okay, so speculation. If traders believe a currency will move in a certain direction, they will trade accordingly and may cause the currency to go up or down. So if traders believe a currency will move in a certain direction, they will trade accordingly and may cause the currency to go up or down. They will trade accordingly and may cause the currency to go up or down. Intervention by central banks. Central banks can intervene in the foreign exchange market to try to stabilize or devalue their currency. So what the Bank of Japan does, they can do this by buying or selling their own currency or foreign currencies. Central banks can intervene in the foreign exchange market to try and stabilize or devalue their own currency. Through buying or selling their own currency on or foreign currencies. Through buying or selling their own currency or foreign currencies. Yeah, so where is it? Central banks. Yeah, so Bank of Japan has been known to enter the open market to artificially weaken its currency by selling it against the Euro USD. So adding more of the JPY into the market, which increases its supply, but if the demand stays the same, then the value of its currency is going to drop, or the exchange rate of it is going to drop. So yeah, it should be noted that currencies are traded in pairs and their values are relative, so the currency goes up or down when compared to another currency. For instance, if the USD depreciates against the Swiss franc, it means that one USD can buy fewer Swiss francs than before. Yep. 7 currencies worth more than the USD. The table below lists 7 currencies that are valued higher than the USD. 7 currencies worth more than USD. Swiss franc, CHF, 1.15, Caymanian dollar, KYD, 1.21, GBP, 1.28, Jordanian dinar, 1.41, Omani Rial 2.6, Bahraini dinar 2.65, Kuwait dinar 3.25. Excuse the poor pronunciation. Swiss franc 1 CHF equals 1.15 USD. The Swiss franc to USD fluctuated between 0.9862 and 1.13 from June 2022 to June 2023, so within a year. Lowest exchange rate was observed on November 3rd, 2022, when 1 CHF was equivalent to 0.9862 USD. Highest exchange rate over the period occurred on May the 4th, 2023, when 1 CHF was equivalent to 1.13 USD. Average exchange rate over this period was 1.06 USD. From June 2022 to June 2023, Switzerland's economy experienced a slowdown, with GDP growth decreasing from 2.1% in 2022 to an expected 1% in 2023. Amidst high global economic uncertainty, inflation, which peaked at 3.5% in August 2022, was reduced to 2.6% by April 2023 due to decreases in energy and food product prices, and was projected to further decrease by projected to further decrease to 2% by year end. The Swiss National Bank, the Central Bank of Switzerland, responded to these inflationary pressures by tightening monetary policy, with policy rate hikes expected to further reduce inflation to 1.9 in 2024. Despite these economic challenges, Switzerland maintained political stability, continuing its dialogue with the EU regarding single market accession. These factors, economic performance, inflation, monetary policy, and political stability, likely influenced the Swiss franc's movements during this period, with the economic slowdown, inflation potentially exerting downward pressure, and the central bank's policy rate hikes and political stability providing support. Right, well, let me just see how this works here. USD was worth more than CHF at that point in time, when 0.9862 USD could be exchanged for 1 CHF, and then CHF was worth more than USD when 1.13 USD had to be exchanged for 1 CHF. Lowest exchange rate was observed on November 3rd, 2022. Highest exchange rate May the 4th, 2023. Okay, so June 2022 to June 2023, Switzerland's economy experienced a slowdown, with GDP growth decreasing from 2.1% in 2022 to an expected 1% in 2023. So the gross domestic product growth decreased from 2.1 to 1%. Key indicator of economic growth is GDP, gross domestic product. So The measure of the sum total of a country's entire goods and services. That should have that at the end. The measure of the sum total of a country's entire goods and services. The entire country's goods and services decreased. I guess you could say the country's productivity has gone down. Amidst high global economic uncertainty, inflation, which peaked at 3.5% in August 2022, was reduced to 2.6% by April 2023 due to decreases in energy and food product prices. Okay, so May, just draw a timeline here. So we got, this is the 2022, this is the 2023. Right, okay, so lowest exchange rate was observed on June 2022, November the 3rd, 2022. So this was .9862. And then May the 4th, so let's put May over here. $1.13. So overall, we got let me just draw a GDP decreased. Inflation, which peaked at 3.5% in August, so inflation goes up, was reduced to 2.6% by April. So that went down in April due to decreases in energy and food product prices, which was projected to further decrease to 2.2% by the year end. Swiss National Bank central bank responded to these inflationary pressures by tightening monetary policy, with policy rates hikes expected to further reduce inflation to 1.9% in 2024. How do I look at this then? So GDP was this inflation. This is inflation, isn't it? Inflation. We got November's 0.9862, 1.13. So GDP's gone down. Inflation's also gone down. The exchange rate's risen, so that means CHF is strengthening against the USD. But if its GDP's gone down, that means this country is being less productive than before, with the economic slowdown and inflation potentially exerting downward pressure, and the central bank's policy rate hikes and political stability providing support. Right, okay, so this is what's making, potentially exerting downward pressure. This bit here where it's increasing to an all-time high, did they say it was? Increasing to 3.5% basically before. So that bit has gone up. So with the peak of inflation and then also the decrease in GDP, this would cause the currency to, when did it peak at 3.5%? August. So that was, let's write org. So August, November, that's 3 months away. So peaks at August, GDP decreases. Inflation is still high, I think. Is that high? I'm assuming it's going to be a high number, that causes the CHF to weaken against the USD, because investors are not just attracted. Investors aren't attracted to the currency because of the high inflation rates and the decrease in GDP. August reduced to 2.6% by April 2023. So April 2023, somewhere around here, inflation rates have been reduced to 2.3% to an expected 1% in 2023. GDP is still expecting to be dropping to 1%, but then inflation has been reduced to 1.9%. Oh no, to 2.6% by April. So inflation is going down, which means there's going to be more purchasing power for the foreign investors. So they're hoping that would offset the decrease in GDP and also the political stability. That gives an attractive outlook for foreign investors. So that means the foreign investors would want to buy more CHF. So as the demand for CHF increases, so does its value. So CHF rises in value against the USD, which means it will take more USD to buy one CHF. So then the exchange rate rises in May after the April 2.6% of inflation goes to 1.13. To be honest, yeah, that's how it goes. I don't even know if that's clear the way I said it or not. I think it's clear, but I think in the next video I'm going to be starting off with redoing this and try to re-explain everything just to make it clear once again. I am going to leave this episode here then, so thank you guys for watching and I'll see you then. Peace!